Imagine two friends. Both are 25 years old, both have similar jobs, and both dream of becoming financially free. The first friend spends every extra dollar on gadgets, vacations, and things that lose value over time. The second friend discovers something called a mutual fund. He doesn't know much about investing, but he learns one important lesson. Wealth is built slowly, not overnight. Every month, he decides to invest just $200 into a mutual fund. At first, nothing exciting happens. His account grows only a little. Meanwhile, his friend continues spending money and enjoying immediate rewards. Years pass and the investor sometimes feels discouraged. The stock market goes up and down. News channels talk about crashes, recessions, and financial crises. Many people panic and sell their investments. But he remembers why he started. Instead of quitting, he keeps investing every month no matter what happens. A mutual fund is simple. Thousands of investors put their money together into one large pool. Professional managers use that money to buy stocks, bonds, and other investments. Instead of trying to pick the perfect stock, investors own a small piece of many companies at once. This reduces risk and makes investing easier for beginners. When the market drops, shares become cheaper. While most people are afraid, the investor continues buying. Because prices are lower, his monthly investment purchases more shares than before. He doesn't realize it yet, but these difficult periods will become some of the most profitable moments of his investing journey. After 10 years, he checks his account. The growth surprises him. The money he invested has increased significantly. More importantly, his investments are now generating earnings of their own. This is the power of compound growth. His money is working even while he sleeps. Every year, the earnings create more earnings, and those earnings create even more earnings. The snowball continues growing. His friend notices the difference. The gadgets he purchased years ago are now worthless. The vacations created memories, but no financial assets. Meanwhile, the investor owns pieces of hundreds of companies through his mutual funds. His wealth keeps growing without requiring extra effort. As the years pass, the investor learns another important lesson. Successful investing is not about predicting the market. It is not about finding the next hot stock. It is not about getting rich quickly. It is about consistency. He invests during good times and bad times, during market booms and market crashes, during economic growth and economic uncertainty. 20 years later, the difference becomes dramatic. His investment account is worth several times more than the amount he originally contributed. Compound growth is accelerating. The account grows faster each year because the earnings are now generating substantial additional earnings. Many people ask him for his secret. They expect a complicated answer. Maybe a special strategy, maybe insider knowledge, maybe a risky investment that delivered huge returns. Instead, his answer is disappointingly simple. I invested every month and never stopped. People often underestimate simple habits because they are not exciting. But simple habits repeated for decades can create extraordinary results. By age 65, the investor has accumulated enough wealth to retire comfortably. He is not a billionaire. He never became famous. He never invented a company. Yet he achieved something millions of people dream about: financial freedom. Looking back, he realizes that the most important decision wasn't choosing a specific mutual fund. The most important decision was starting early and staying consistent. Time did most of the work. Compound growth did the rest. The lesson is clear. You do not need to be rich to invest. You do not need a finance degree. You do not need perfect timing. What you need is patience, discipline, and the willingness to let your money grow over time. Mutual funds are not a get-rich-quick scheme. They are a get-rich-slowly strategy. But slowly is how real wealth is built. Small investments made consistently can become life-changing amounts of money. The earlier you start, the more powerful the results become. Remember, earn, save, invest, repeat. That simple formula has created countless millionaires, and it can work for anyone willing to stay committed to the journey.